Hey everybody, today we're going to be doing another dividend analysis and we're going to be looking at NEM or Newmont Corporation. For anyone who doesn't know, Newmont is a gold miner and producer and the only gold miner that is currently in the S&P 500. So first let's take a look at our yield. What we can see here, 2.5%, this is actually incorrect. It should be 3.5% because they just recently announced their next distribution, which is coming up shortly, is going to be 55 cents a share as opposed to the last 40 cents a share. So we should be looking at a 3.5% dividend yield, which is on the higher side of average. 2.5 to 3.5% is your average-ish dividend yield for what you would consider a dividend stock. So this is going to be from the lower end to the higher end of average. If we take a peek at their dividend history, we can see that it is actually very unstable. If we go back to 2013, we can see we were getting 25 cents a share, but then we decreased down to just 2.5 cents a share when gold prices tanked about 8 years ago, 7 years ago, give or take. And then it's steadily been increasing since then. We have an 88 cents dividend here, but this was a special dividend, so don't pay much attention to that. But we can see we've been getting back up, and now we're sitting at 40 and then 55 cents. If we actually take a peek at their total dividend history, we can see that it is indeed very interesting. The dividend payout has gone from 32 cents down to 9 cents, back up to 32 cents, skyrocketed up to $1.29, crashed when gold prices crashed, and skyrocketed up again, crashed with COVID, and then skyrocketed up again. So this is a very unstable distribution, which is something we really don't usually look at. We want to see that dividend increase over time, or at the very least, no cuts over time. So here we've had, in the last, let's say 21 years, we've had, two big run-ups, or 3 big run-ups and 2 big dips. So that's a little concerning there. We want to be careful of that. We want to keep that in mind while we look at this dividend further. So let's go take a peek over at our cash flow, and we will see how that has been doing over the last 5 years. We can see we've gone from 1.65 billion up to 3.5 billion last year. A little unstable again. We dipped down below $1 billion, then skyrocketed up to 3.5 billion. So while we are increasing over the past 5 years, it's been rather unstable. Now let's check our payout ratios. Newmont paid out about $800 million in dividends last year, so let's go ahead and divide that by 3.58 billion. That's going to give us a 22% payout ratio, which is very good, well under our 50% ideal range. Excellent. So we can see as their cash flow has increased, they've increased their dividend to compensate for that. Next, let's go take a peek at our income and see what that's looking like. All right, as we can see here, we went from a loss of 22 million up to a gain of over 2.5 billion in income. So again, a very good upward trend. And as we can see, this isn't as unstable. We've been increasing steadily over the past 5 years with a couple of big jumps. So again, let's take a peek at that, see what our ratio is, and we are looking at about 30%. Now granted, this is with last year's payout ratio. This year's is going to be higher because we're moving up to 55 cents a share. So keep that in mind. While we're under 50% here, if we see any decreases in income or cash flow and we stay at that 55-cent dividend, these percentages are going to go much higher. So keep that in mind. This year it's going to be very important to look at the net income and the free cash flow for this year ending 2021 to see if those numbers are increasing so that these percentages stay this low. Now, where's this income, where's this free cash flow coming from? As a gold miner, gold producer, pretty much their entire income is selling the gold that they mine. They also mine a few other precious metals, silver, platinum, and a couple of other things, but those make up a much smaller percentage of their income, it is primarily based on gold. So when you're looking at a company like this, it's going to be tied to the price of gold. As the price per ounce increases, this company's, not only is their share price going to increase, but their income and their free cash flow are going to increase. Therefore, their dividend might increase. On the flip side, if gold prices tank, as they have a couple times in the past 20 years, you're going to see this dividend likely go with it, because as the income and the cash flow drop, because they're not going to make as much per ounce that they sell, their dividend is going to likely fall because, excuse me, to compensate for that falling free cash flow and falling income. So, bottom line, is this going to be a dividend investment for you? This really fits into one category of dividend investments, and that's if you have a portfolio and you're looking to diversify into a precious metal, but you want to make income off of it. You don't just want to buy, a gold ETF that just holds gold in your name. You don't just want to buy physical gold. You want to get into the gold market, but you want to be able to make income off of it. And at 3.5%, this might be something for you. The only problem is you have to realize that this is a very unstable dividend. It's going to move with the price of gold. Therefore, if you're bullish on gold, if you see $2,000 an ounce gold as a real possibility, then this is probably something for you. If you're more on the bearish side and you think gold is going to go back down to $1,200, $1,300 an ounce, I'd stay away. This is very much going to depend on how you see precious metals working. If you're on the positive side and you want to diversify into that while maintaining an income portfolio, this could be a stock to look at for you. Otherwise, due to the instability, due to it relying on an underlying asset to really give you that dividend, I tend to avoid it unless you're in that particular group of investors. There's going to be other 3.5 to 4% dividends out there that are going to be much more stable, that you're not going to have to follow the price of gold. So really, for most people, this is probably going to be a pass, but if you're looking to get into those precious metals while maintaining some kind of income, this might be for you. I hope this helps, and thank you for watching.